Everyone, good evening. How's everyone doing today? So, my name is Peter Eki, with the EXP Realty in Calgary. I'm a realtor, real estate agent, and then myself and Adriel, we are going to be your host for today. Welcome to the first time home buyers class. Today we're going to be talking about costly mistakes that we have seen first time home buyers make over the last few years that can cost you a pretty penny. And then, so the goal of the webinar today is to educate people, kind of let you know a bit more about the home process, mistakes to avoid. If you do make the mistakes, the kind of money you could lose from making such mistakes, in hopes that everyone can kind of be a bit more comfortable about the process moving forward. Adriel, next slide. Okay, so as a first-time buyer now, just a real quick question. You guys on here, do you feel, say, concerned, stressed out, intimidated, anxious, or uncertain? You can type your answers in the chat box. So let's see kind of where you guys are at. I like feedback, so, feel free, just chat real quick. There's no right or wrong answer. Yep, that's fine, not to worry. Yep, so how are you guys feeling so far? Before now, concerned, stressed out, a little anxious, concerned, and uncertain. Okay, Bjordan, I see that. Awesome. Okay, no problem. So the goal of this is to LM says all of them. Okay, no problem. Blanco says concerned. Okay. Concern. Okay, so lots of concerns. Okay, no problem. So at the end of this webinar, hopefully we'll be able to move the majority of you off of the concerned emotion. Next slide, Adriel. So one last question before we get into things. How much do you guys think you'll be able to save from being on this webinar? Is that 10,000, 20,000, 30, or 50? Once again, no right or wrong answer. Okay, I got a 50, a 20, a 10. Okay, cool. So I'm gonna give you a hint. It's actually more than 50. I just have 50 here as the maximum number because we don't want to overtoot our own horn. Adriel, next slide. So who am I? So I'm your host and first speaker for today. My name is Peter Eki. So I have been in Calgary since 2004. That's how long I have been in the city. I am married, so the lady beside me to my left, that's my wife, and beside her, that's my sister, and then that's my mom. I'm a realtor for about 11, 12 years now. So I've been doing this since 2010, October 2010 to be precise. So I'm very well experienced. I've seen all the different kinds of markets, at least 2, 3, even going 4 times because of how long I've been in the business. I'm currently with EXP Realty. And one of the reasons, so one of the, I guess, perks of being in the business a long time is I've been able to handle many transactions. I'm also a top performing real estate agent. You see the 2 pictures on the screen there, me getting awards. So I'm pretty productive. And then also I take really good care of my clients for those who choose to work with me. So you are in good, safe hands if at the end of this, as we're talking further down the road, if you decide to work with me. Real quick, all our services on here are free and we're also not pushy. So we are not gonna chase after anyone. We don't disturb people. None of us here are pressure people. So that's enough about me. Next slide. So Adriel, introduce yourself.
Hello all. My name is Adriel and I am a mortgage broker, but how did I get into that? You're probably wondering. So my uncle and my father were actually my inspiration, but not in terms of financing and mortgages. I have an uncle and a father and a brother and a cousin who are all in cabinet making and all in woodworking. And so when I graduated high school, it's like, well, what am I going to do? Let's get a trade under my belt. And so that's what I did. I go into the trades, and it was pretty fun at first. But about 2 years into it, I was like, I'm not really into it. And so my interest lay a lot into something a lot more bland to others, but more interesting to me. I was very interested in learning how the financial sector works, specifically the banks, and how our currency is debt based, and all these different kind of things. And I just loved that aspect of the financial sector. So in my spare time, I read the boring things like the Securities Transfers Act and the Bank of Canada Act. And I just primarily wanted to learn how to leverage debt to increase one's wealth. And that's what I did. And I found something that is just absolutely, truly passionate to me. And I just love it. I love what I do every single day. And the brokerage that I'm part of has funded 450 plus mortgages in its first 12 months. So it's just a crazy, crazy cool volume that we're doing and helping so many families out. And so what are the steps to home ownership? So the first thing is coming to this class and learn everything and as much as you can about the mistakes to avoid, which is a really, really good first step. So congratulations and good on you for coming out and hearing and learning about what not to do. So then the second thing is to get a pre-approval from your mortgage broker. And it's normally the steps that would be with me would be a discovery call, then possibly a mortgage application, or it could be just further planning to get some more ducks in the row for something to happen, maybe next year or 2 years down the road. It may not be today, but it's something that we can always look at the discovery call and see what happens. And if the next step is to the approval, I'll send you a link to go through an approval process, and then I'll get you pre-approved, and I'll send you on the way with your realtor, and you go searching and finding, hopefully with Peter, and you find a home, then you offer, negotiate for that home, and depending on the type of property, you do a home inspection. Highly advise it. It's not mandatory, nor is a condo review, but when you're in those kind of properties, definitely strongly recommend it. Then you finalize the financing, you do a waiver. There's a waiver to sign, then you sign with the lawyer all the official documents. You get everything approved, and then you move into the home that you want. In terms of what I would do for you, and in terms of with every single pre-approval person that I get, I do a breakdown of a budget, and this looks really overwhelming, but don't worry, I do a video and I send it to you, and I break down every single line through this. And then we also hop on a strategy call further down the process, and we talk about the different options of what is best for you and what's suited best for you in terms of your mortgage. So mistake number one is thinking that the mortgage interest rate is the most important thing. And most people think when they go shopping for a mortgage, they think low rate, low rate, low rate, low rate. Now, that is not the most important thing when looking for a mortgage. Is it important? Absolutely. Is it the most important? Not. It is not. And let me tell you, and I'll explain why throughout this presentation. But in terms of what is the best way to save money with a mortgage and in the home buying process, and when you have a mortgage for the duration of the 25 or possibly 30 years, is that you have the right mortgage product that suits your lifestyle. Then your penalty. What are the penalties to break the mortgage? What are the prepayment penalties? All those kind of different kind of things. And then the rate. So 50% of importance is the product, 30% is the penalty, and then the rate is only 20%, because your rate's going to change quite a bit throughout the life of the mortgage. So is it important when you first start? Absolutely. But again, product and penalty are the most important, and I'll explain why as we move forward. Mistake number two is possibly ignoring the first-time home buyer incentive. This isn't a dead set money saver, but it depends on what your goals are with your home buying process. So what is the first time home buyer incentive, and kind of how does it work? So the government of Canada wanted to make home ownership more affordable. So they made sure that you are able to put 5%, minimum 5% down on your property, and they'll match the 5% on that property, so that your monthly amount of payments per month are going to be lower than if you were to just put the 5% down. So it is a shared investment in the home, and the government of Canada would have shares in both the upside and the downside of the property value. The loan is non-interest bearing, there's no regular principal payments, and it's repayable at any time without a prepayment penalty, meaning that you don't have to pay it during the life of the mortgage. So when you sell your home, for example, then you pay it on a lump sum. You can, or when you do a refinance and you take out equity out of the home, then you would have to pay that back when you do so. So it's an important thing to consider, because that's where the money is when you're doing home ownership, is the equity in the home. So borrower eligibility for the mortgage loan insurance and the lender eligibility requirements apply. So in terms of, do you need to be a Canadian citizen? No, you can be a PR, you can be a non-permanent resident, as long as you're legally authorized to work in Canada. And at least one homeowner in the home or the household must be a first-time home buyer. You need the combined qualified annual income has to be $120,000 or less to be able to qualify for this incentive. The combined insured mortgage and incentive amount cannot exceed 4 times the total qualified annual income. So, and that's just a general with most lending, but it's not as cut and dry. There's so many variables. That's why I do what I do, is because it's not that simple all the time. But that's a good way to get an idea of how much you would be pre-approved for, is take the gross amount of income that you make per year, or the qualified annual income, and times it by 4, and that's around the average amount that you would be pre-approved for. Again, there's more variables than that, so take that with a large grain of salt. The maximum down payment, including the incentive amount, cannot exceed 19.9%, because if you go over that amount and you're at 20%, then you no longer are in mortgage insurance amounts. So you're avoiding mortgage insurance. So this program wouldn't apply, because CMHC, the Canadian Mortgage Housing Corporation, would not be involved. So can you also, sorry, just one second. Can you use your RSPs as well? Yes. So the first time home buyer incentive, and you can also withdraw up to $35,000 from your RSP per borrower under the home buyer plan, but it's not connected to the home buyer incentive. So these two are exclusive. One is not tied with the other. So if you're a first time home buyer, you can take out $35,000 from your RSP. That's the maximum amount you're allowed to borrow, and you have to repay that back during your mortgage. You can't leave it empty, because they want to see that you're saving up for the future. So you got to keep that up as well. But both programs define the first-time home buyer the same way. If you were wondering what the requirements are and what criteria is, the government of Canada has a really clear page of what the first-time home buyer means, because there's a lot of different kind of loopholes in what that means. Okay. So how does the first buyer incentive work? So when the home sells, like I said, at any time the first 25 years by one lump sum, or a mortgage refinance, again, one lump sum payment, it cannot exceed at 25 years. So again, one lump sum by way of lump sum, or a small equity loan, out of your home, but you have to pay it back within 25 years. So here's a payoff example of what it means to having the shared equity in the home. So here's how to calculate the repayment amount at 10% from the original incentive. So let's say you're purchasing a home with $40,000. You're putting up 5%, just $20,000, and the government's putting the other 5% down for another $20,000. That's $40,000 down. If the fair market value goes up by $100,000, being $500,000, then the repayment amount will be $10,000 more at $50,000. If the fair market value goes down by $100,000 to $300,000, that means the repayment amount will be $10,000 less than the original down payment, meaning the repayment amount is $30,000. Does that make sense? So Anita wants to buy a new home. Purchase price of a new home, $400,000. Minimum down payment of 5%. That's going to be $20,000. The mortgage amount without the incentive would be $380,000. And then with the incentive, with the extra 5%, with the $20,000, your mortgage amount after the incentive is applied is $340,000. Yeah, that's just the basics of it. That's without excluding mortgage insurance, which I don't want to confuse the numbers here. So just to keep it simple. So without the mortgage insurance calculations here, the 5-year payment reduction is about $13,800. CMHC insurance savings is about $5,680 from the 4.4% down to the 3.1% that you'd be paying at a 10% down payment. And there's a total 5-year savings of the life of that term is $19,480, just based on the amount the savings you would pay from, just the cash flow savings amount that you would pay per month. You would save about $19,480. So it is something to consider. So mistake number 3 is not getting a pre-approval done. And so how is a pre-approval or approval for a mortgage calculated? So there's 5 conditions, it's called the 5 C's of credit. Every single lender goes off of these 5 C's of credit for a mortgage. So number 1 is character. So we're going to look at your credit. We're going to see, have you paid your bills? Have you made amends for past credit mistakes? Like, how good are you at managing, let's say, a credit card, a line of credit, a car loan, whatever it is. That those are all considered in terms of how they calculate your credit score for the credit bureau, and it's really important for your character. 2 is conditions. So though they look at employment type and then type of property and market value of the area, etc. So there's different the conditions that they just want to ensure that there's stability for you as the borrower and the property itself. Number 3 is the capital. They're going to look at your net worth, and the savings patterns, the spending patterns. So capital is really important, is to help mitigate risk. So let's say you, let me finish this here. Number 4 is capacity. They'll look at debt servicing ratios to ensure you can afford to not only pay the mortgage, but live and take care of the property as well. So that's really important, because if you're, kind of scraping everything together and you get, you buy the house at the maximum amount that you're pre-approved for, you're probably what's going to be called house poor. Now, house poor just means that you've put a lot of what you're making into your home, but you don't have enough money to really make improvements on that property, which is an important thing to consider. Every few years you might need to get a new roof, or the appliances are old, or whatever that could be. They want to ensure that you can upkeep the property and as well live comfortably, because you don't want to be able to just be at home and not be able to go live and go do things and spend time with the family and go, live life, right? So that's an important aspect to consider. And 5 is collateral. So the lenders highly scrutinize the property being purchased, especially in high ratio loans. So if you're putting less than 20% down, the property is highly scrutinized in terms of risk for the lender. So early on the mortgage, because you don't have a ton of equity in the property, they want to ensure the asset is highly marketable. So if they do need to take back the house, in case that happens, which is not a good scenario, they want to make sure that it'll be marketable and easy to sell, and that they're not holding on to a massive liability in the end. In Calgary, it's not going to be an issue, so don't really worry about that too much. Or the Calgary area, or anything in Alberta, to be honest, except really, really small towns that are far away from big cities. I'm going down a rabbit hole. My apologies. That's what I was going to say. With these 5 C's of credit, for example, it's important to have most of these areas fairly strong. So if, let's say, there's 2 out of the 5 C's that aren't as strong, they want to see the other 3's quite a bit stronger because it's like a 5 legs chair. If you have 3 or 2 to 3 weak legs, the chair is quite unsteady, and that they want to make sure that it's a solid chair and that you're a solid borrower. So let's say the character and the conditions are strong, they're going to want to see the capital capacity and collateral to be strong. There's a lot that can happen when capital is really strong, when you have the 20% down. So in the A side of lending, when you have the character, conditions, capital capacity, collateral, and all pretty good, that's a very important thing to consider. And that's why you would want to book a call with me, because then you can understand kind of where you're at with it all, and I can help you understand kind of where to go from there. So I did not mention this yet. So the underwritten pre-approvals, mortgage brokers talk about them, but they don't really happen because most lenders don't actually pre-approve underwrite pre-approvals, meaning they're going to look at the documents, they're going to review credit, down payment source. That's what we as mortgage brokers do. So we go through your income, we go through your credit, we go through your down payment source, and we'll come back to you with a reliable and a maximum qualifying amount that I can give you, and with your permission, tell the realtor, and then you guys can go shopping. And then we also monitor the rates. So we get lender update emails in terms of rates and say, hey, rates are going up at this tonight or tomorrow or this weekend or after the weekend. And then we'll throw your file into a pre-approval or to the lender. And we're going to get you a rate hold to make sure that we get the rate hold so that you're still qualified for what you said, for what we told you you're qualified for. Mistake number 4. Ooh, wow. Ooh, that's not 4. That's 4. So using your bank is important as a mistake, because right here on the left here, this is what happened to this poor lady when she wanted to sell her house in June, in June here in the spring of 2020. And as we all know, that was pandemic time. Because the interest rates dropped so much during pandemic time in the last few years, when the lady wanted to sell her home, the bank charged her $30,000 for her mortgage penalty. And remember when I talked about how the product is the most important, then the penalty, then the rate? This is why. Because if you're with like one of those big banks, I'll show you why very soon here of why these penalties are so high. And the TD Bank client, again, on the right here, and that was back in 2014, is devastated by another $17,000 penalty. So these penalties are quite high, whereas with a monoline lender, an investor-backed lender, not a conventional lender that we as mortgage brokers have connections to, these are rarely ever exceeding over $10,000, no matter the climate, just dependent on how when you're breaking the mortgage and all those different kind of things. But what I'm trying to say is that the penalties are far less. So the bank penalties are expensive. So there's 2 ways that every lender calculates the penalties. It's either the greater of 3 months of interest or the interest rate differential. And when that last line there, how the banks calculate the interest rate differential is significantly different than the non-bank lenders. And every single bank kind of does it differently. And so there's no way of really knowing or telling you, boom, this is the same for all the banks. But through a lot of research, I can find quite a bit of information. It's all about posted versus discount rates. And I'll explain why this matters, because if you go onto a bank's website, Scotia's, TD's, CIBC, BMO's, and you go onto their mortgage thing, they'll have what's called a posted rate. And then the 25-year amortization, this is what the actual rate you would be given. It's called the discounted rate. And this matters because here, for example, at 5-year fixed, you have 4.59% and 2.09%. The interest rate difference between that is quite large. So I'm going to walk you through this example and explain why it's important to consider the lender you're going with. So here we have the exact same 5-year rate at 2.79% and 2.79% from 2 years ago. So there's a couple, they bought a house, and about 2 years in, they're like, you know what, we want to sell, we want to break the term of the mortgage. And so they have 3 years left of their 5-year term. So here's a 5-year posted rate from 2 years ago. And that's 4.79%. So you can already see that there's a 2% interest rate difference, right? So there's a current 3-year posted rate of 3.89%. So the way the banks normally calculate the interest is they take the current 3-year post rate, the remainder time of the mortgage, so that being 3 years, then they subtract it from the difference of the interest rate differential, the difference of the rate from the post rate and the discount that you initially got. So it's the discount you got at the start of your mortgage. So 3.89% minus there in the brackets, that's going to be 2%, and that's going to equal 1.89%. So they take that $400,000, which is the remainder of your mortgage balance, they multiply it by that interest rate differential, and they times it by 3 years, because that's only one for 1 year, and then that's the amount you would pay. So since the interest rate differential is more than just paying 3 months of interest on the $400,000, your extra penalty here would be $19,890. Whereas on the monoline side, they don't really have posted rates, and if they do, they're very, very minute and not even close to this. If it's 2.79%, at most it'd be like 2.99%, but most of them don't have posted rates, so they just have the discounted rates for us. So you have 2.79%. Then during that time, there's a 3-year current rate of 2.19%, whereas the bank used a posted rate. So their current rates were probably the same, or this was slightly higher, but they took the current posted rate on the bank side, whereas on the monoline side they used the discounted rate. So that's 2.79% minus 2.19% equals 0.6%, which 0.6% on $400,000 is not very much money. It's only like $600 for an interest rate charge. So they take 3 months interest, which is greater than the interest rate differential, and that gives you 3 months interest is equal to $2,790. So you have a ton of savings with that, an extra penalty on the rate there. So it's very important to consider your penalty and what product you are getting, because the penalty and the product go hand in hand as well. And over to you, Mr. Peter.
Hey everyone. So mistake number 5. So thanks you for staying so far. We're getting pretty close to the end here. So mistake number 5 that I see new home buyers make quite a bit is buying directly from a builder. Now, is this wrong in and of itself? Not necessarily. The problem is that because you don't do this every day, you don't know what things to look out for. Andrea, next slide. So if you were to go to a new home builder now, you see the house here to the left with the fire hydrant beside it, the one that's attached. So that one is the corner lot. So if you went to a builder now, because the corner lot has extra land, you will get charged a premium on this lot that we're looking at. But it's got a fire hydrant beside it, network green box beside it, and also Canada Post mailbox beside it. All those things reduce curb appeal for the home and will reduce your resale value. If this lot had one of those really big green boxes, those power ones, then you're looking at easily another 20,000 less on resale value for when this person is looking to sell. So there are lots of things that can affect and will affect the resale value of your home that you guys don't know, because obviously you don't do this every day. You are not real estate agents. You don't sell resale homes. So there are things that you will obviously not know. But when you go there with a trusted agent who's honest and who knows these things, he can ask the right questions in order to help you, help prevent you from picking a bad lot or bad location and all that. The house here to the right, these units are backing onto Shaganapi Trail. So for this particular one, I had a client who came to me. They wanted to sell their home. They were unfortunately going separate ways. They had been in the home for just under a year. So this house, it took an additional 3 to 4 months to sell, just because it was backing onto Shaganapi. Now, when they bought this house, the builder had told them it was a great location, but they did not know that it wasn't because it's backing onto a highway. Shaganapi is about 80 kilometers per hour. So the units opposite this one, they sold for about 20 plus grand more than ours, and they sold in like a month or two, whereas ours was on the market for about 3 months extra. And for each time your unit stays on the market more than it's supposed to, you're adjusting the price, right? So between those two things, upgrades and all that, they try to sell you some upgrades that you don't really need, that don't add to your resale value, they're just good for, looks good. So I help you avoid a lot of mistakes that will come and bite you in the bum later on when you want to resell. So that's kind of one of the many things that I do. Next slide, Adriel. So your cost from going to buy straight from a builder without going with an agent, it'll hit you anywhere between 5 to 40,000 easily. Could even be more if you happen to pick a lot that has multiple factors working against it. And as you know, most of the people working at the show homes, they sell just new homes. They don't do resale. They're not real estate agents. So a lot of them don't know factors that affect resale. And for the ones that do, they are there to represent the builder and not yourself. So when you do go there, kind of something to keep in mind. They are working for the builder and not you. So it's not their role or their job to tell you these things in order to help you. And that's for the ones that know. Next slide, Adriel. So that's why it's better to go with someone who's on your side, who's actually on your side. Because when I take you there, I am on your side, not their side. Mistake number 6 will be skipping the home inspection. So because home inspection comes with a cost, which depending on the size of your home, will be anywhere between 5 to 7, sometimes $800. At times you will see builders want to skip out on the home inspection. Skipping out on home inspection, it may not be the best example, but I'm going to use it anyways. Skipping out on home inspection would be like jumping into a marriage with someone without getting to know them, because that's basically essentially what you're doing. The home inspection, it gives us a health check on the home, what's good, what's bad, what are you going to need to replace soon, and any major problems with the house that we should be talking about right now, and maybe going back to get a discount on the price that we've already agreed to on the house from the seller, and all those kinds of things. And even for new builds, I find that even with the new construction, when you do home inspection on those two, you still catch things with those two. There was a time one of my inspectors, Chris Odd, one of the biggest inspectors in Calgary here. So we were about a week away from taking possession of a brand new build. So we had this the pre-walkthrough that the builder scheduled about a week to the time. So we go there with the inspector, and he's doing his thing, which he usually does to the home. So one of what they do that they fill up all the bathtubs in the home with water, and then they let them drain to make sure that, there's no leaks, or the pipes are working and everything. So he did that. He goes back downstairs outside, grabs his laser gun, which they used, so infrared thermal gun. It kind of gives them an idea of what's happening behind the drywalls, because when you're doing inspection, you can't be invasive and kind of start breaking people's drywalls. So that helps them see behind what's happening behind the walls. So he comes into the living room, kind of looking around. He looks up, and there's like this big blue spot right on the roof of the living room there. So what was that? The bathtub in the master bedroom, one of the builder's tradespeople did not connect the outlet pipe taking water from the tub, into the drain out of the house. So the water was just sitting right there in the roof. So if we did not do the home inspection, the lady would have taken possession of that home. She'll be all happy, and then about maybe a week or two, poof, the thing collapses and the floors are ruined, TV ruined, and all that, and then the inconvenience that goes with that. So we were able to catch that, I thank God. And it delayed the possession, obviously, because the builder had to now come in there and basically puncture, pop a hole in the wall, and the whole thing just fell down. And they fixed the flooring and everything before we finally took possession of this unit. So it can be a big deal skipping possession, and the peace of mind that comes with that is incomparable, even with the money you have to pay for the inspector to actually do the home inspection, because you're making an acquisition of 3, 4, 5, 6, 800,000, sometimes maybe close to $1 million. That's, $500-600 you're making for home inspection is worth it, extremely worth it. I would never advise anyone to skip it. Cost of skipping home inspection will hit you anywhere between 2 and 20,000, and that's on average. It can be more than that. I've seen people buy homes that had serious foundational issues, and they were on, they had a $50,000 bill that they obviously could not afford. So that's a huge one. Adrian, next slide. So the next mistake here is with regards to condo document reviews. So if you're buying a apartment home or you're buying a townhouse, they're both called basically condos. So one of the things with regards to condos is, think of it as you are buying into a pool or you're buying into an organization or an association. So if you're buying into an association or a company or whatever, before you do so, think of it like shares. Before you do so, you need to kind of understand, hey, is this company, are they working properly? Do they have their money game in check? Are they being managed properly? All that and all that. Anything's coming on down the road that I should be aware about. So during the condo document reviews, we get a professional to go through all their minutes, check to see if their reserve fund is okay. So how much money do they have in the bank to manage the units or to manage any major projects coming on down the line and all of that. So with regards to condos, there's something that happens if that particular project does not have enough money to cover all the spend upcoming for that unit, they do what's called a special assessment. Now, with a special assessment, let's imagine a townhouse. Now they want to do a siding project, and let's say it's going to cost $1 million to fix all the units in there. Let's say they have only 600,000 in their reserve fund, so they have like a 400,000 differential that they have to come up with. They will levy that 400,000 across all the units in there, and each person will get a charge, which can be anywhere between 10 and 30,000, depending on how big your unit is or how many units you guys have in that complex. So with regards to condos and townhomes, and all those things don't happen like overnight. They talk about them for a while, and those things you usually catch it somewhere, either in the minutes or the engineering studies or reserve fund studies and all of that. And those are things that come out when you're doing your condo doc review. And it's important to catch those things beforehand, because from the moment you take possession of that unit, if a special assessment comes out the next day, it's the current owner that's on the hook for that money. So it doesn't matter if the other person's been there for 10 years, he was supposed to get the assessment, but now he's gone and I just bought it today, and then the thing officially comes out tomorrow. I'm the current owner, I'm on the hook. So those are things that come out during the condo document review. And it's extremely, extremely important, because the last thing you want to get caught is holding the bag of, someone else's, trying to be smart on you or trying to pull a fast one on you. So I've heard a few horror stories of people not doing the condo doc reviews and being burned. And also there's a few projects, condo apartment buildings in the city right now that you can't even buy because of the special assessments they have in there, and nobody wants to sell them, or insurance issues because it's a really big fix and you can't even get insurance to cover the unit and actually purchase them. So there's quite a horror show happening with some of the condos in the city. So you always want to do your own condo document reviews. Average cost of skipping condo doc reviews will hit you anywhere between 5 and 50,000, sometimes even more than that. And the average spend is about $400 for condo doc reviews, so it's not a lot. And for the value it's giving you back and the peace of mind, it's money well spent. Yeah. Next slide, Adrian. So you guys have been with us for about 40 minutes. Thank you for staying all the way through. How are you guys feeling right now? Still concerned, still a bit stressed out, feeling a little better now that you kind of know a little more? Talk to me. Just in the chats there. Let's see how you guys are feeling. Okay, I'm feeling a bit better. Cool, cool, cool. Okay, so I like to think we did our work a little bit there. Cool, cool. Next slide, Adriel. Saborio, feeling better. Can you talk about insurance? Okay. Sab, are you talking about mortgage insurance? Life insurance versus mortgage.
Yeah, do you want me to touch on that, Peter?
Yeah, go ahead.
Like life insurance is a completely different product, but there's
It's a different thing, yeah.
yeah, so there's kind of, in terms of like in real estate, there's two different kinds of insurance. When I'm talking about mortgage insurance, if you're paying less than 20%, that insurance isn't for you, that's only for the lender. So you're paying the mortgage insurance premium for the lender who's giving you the money. That's not for you. There is called like a mortgage protection plan, or MVP, and all insurance brokers have different plans, and Manulife is the main one that we offer. It's a terrible product, but we have to legally offer it every time at the end of near the end of closing. And that is for you in terms of if you aren't able to keep up with the mortgage payments, then that mortgage plan will be able to help with the mortgage, with the mortgage. And so, yeah, and then life insurance is a whole different product. I don't sell life insurance, but I do know insurance brokers I can connect you with that are specialized with life insurance. How many units can I buy with 5% down as a first-time home buyer in Alberta? That is only one unit that you can buy. There's only one unit you can buy at 5% down, and yeah, that's kind of the general rule. Yeah, that is the rule. One time you can go as 5% down, and then if you like, you can.
You can.
No, that's not true. Sorry.
You can do it up to 2 if you find someone to rent your first house.
Yeah, and like, or you can, like, what you can also do is you can, sorry. You can purchase as many homes as you'd like at 5% down if you first live in them, or they're owner occupied, and then you continue paying down that mortgage or pull out equity out of the first one, and however it is. But if you're in your first home, let's say you put 5% down in your first home and you're putting equity into the home for the next 10 years or so, or 7 years, and you're bringing the loan to value down past 80%, and then you do a refinance and pull out equity out of the home, then you can take that equity out of the home and put it towards a down payment for another property. And as long as you're moving into that property, then you can still use that. You can still do it as 5% down while you rent out the second property. But there's also guidelines for second homes. If you're getting a second home, you can also put 5% down. It all depends. There's a lot of variables. But yeah, exactly what Peter says there. But those want to go a little deeper. I can help go over situation, give you a game plan. If it makes sense to move forward with an application, I can send you a link to do so. I do just want to point out one other thing. So there's this cool program that my brokerage does that every month. It's called Win Your Mortgage Payment. Now, not everyone has a mortgage, but that doesn't matter. So the idea of how this works is you send your referral or someone that needs or friends or family that are closer to the home buying process, or ones that have mortgage questions, or whatever it is. And you send me their contact info, and I have a discovery call with them, just like I would have a discovery call with you. And there's the link at the top of the page there that you can book. And I put your name in for a monthly draw to get your rent or your mortgage payment paid up to $2,500. And then Peter just put it in the chat again, 2 links there to book a call with me for a discovery call. The discovery call is maximum only 20 minutes. And just get a good sense and idea of kind of where you're at. And then I can always take, and then we can always continue with the mortgage process if it makes sense to do so. Mm-hmm. During the pre-approval process, do they carry out a soft credit check or a hard credit check? When you're doing the application, and you sign off for me to do a credit check, that's considered a hard credit check. It will not affect your score. It just depends how often you're getting hard checks done within a 45-day period, and different things. So let's say you just went shopping for a car, and you got a bunch of different, like let's say you got 3 different car shop auto shops to do a credit check on you to get your car loan, and it's within a 30-day to 45-day period, depending on which credit bureau we're using, then that's considered one hard check. That's not going to affect your score. If you're getting a lot of different agencies to do a credit check on you, like you're looking at getting different credit cards and car loans, and you're looking to get a mortgage and all these different checks within the span, a few months, that's going to really affect your score, because it's going to show that you're trying to live beyond your means, and that's not healthy. So when it comes to the pre-approval process, it depends on the timeline. It's probably only going to take a maximum of 2 checks, but it depends. That's why we have a discovery call. Does it make sense to continue with the approval process now, or later down the road, just so that we can mitigate a lot of those things, if that makes any sense. How much should I put aside for closing costs? Very, very good question. Absolutely excellent question. That is on average, you want to look at a purchase price, and Alberta, luckily, we're one of the cheapest in Canada for closing costs. So that's a bonus. But I would say, to be on the very, very safe side, take look at the purchase price of a home and take 1.5% of that purchase price. That is a very good number to go by to cover your closing costs. It most likely will not be 1.5% of the purchase price, but you just want to make sure that you have that capital there, just in case the lawyer fees are going to be a little bit more, because it's a harder property to get, or that the home inspection, because due to the size of the house, is more, or the condo document review is just a little bit more of a process, because there's just a lot, it has a longer history. So there's so many different things to consider. So 1.5% is a really good number to go by when you're looking at a purchase price and be like, do I have enough closing costs to cover that, aside from the down payment of your home, if that makes any sense.
Hey, Gary, do you want to go through the cost breakdown for them? So home inspection, condo, lawyer, and all that. Just give them specific numbers.
Yeah, so for lawyers, they range from anywhere from $400 to sometimes I even seen about 1,500. So,
Yeah,
but
for
on
about
average,
14, 15 average for lawyer legal fees.
yeah, yeah. I seen some take about 1,000, but yeah, I think on the higher end it's about 14 to 1,500.
Yeah,
Home inspections, it also depends on how big the house is. Smaller houses go for about 500, 4 to 500. Acreages go to about 750. So yeah, and then condo docs. Condo docs also vary in between from about 3 to 400 to
yeah,
500, $600.
yeah.
So I would
So
you
so give or take, you should just have like 3,000 in mind just to be comfortable. You won't spend that much, but yeah, just have like three in mind just to be comfortable.
mm,
Ah,
Any more
uh,
questions there?
yeah,
Oh,
Sabori just put one in there.
I deduct the interest from my tax returns.
So actually, I can answer that question
Yeah, go
because
ahead.
I kind of do the same. It depends on the kind of mortgage you have. So like for me now, I have my mortgage is HELOC, homeowners line of credit. So because it's a homeowners line of credit, as a business person, yes, I can deduct like 100% of the interest and write it off as an expense onto my business. So it depends on the product that you have. Yes, you can do that, but it depends on the product that you have.
Yeah, I mean, there is, yeah, like as a first-time home buyer, um, they are putting into place that it is tax deductible with the CRA. That is a better conversation to have with an accountant more than the mortgage broker, but it is definitely something that you can do. Yes, but yeah, it largely depends on the product and your situation. Is there any mortgage available in market without prepayment penalty? Question. So the only thing that doesn't really have a prepayment penalty would be a variable rate mortgage. They don't have prepayment penalties like a fixed rate mortgage. So a fixed rate mortgage, you have your fixed payments, and then most lenders, so the big banks will have a 15% and 15% prepayment plan, that meaning that you can increase your monthly payment amount by 15% at the anniversary of your mortgage, or 15, you can do a lump sum payment up to 15% on the anniversary date of your mortgage. With most monoline lenders, they do a 2020 rule. Yeah, there isn't, most mortgages do have prepayment penalties. I would say in terms of if you want mortgage flexibility in terms of payments and getting out of it, go with a variable rate mortgage. But again, those are the nuts and bolts of a mortgage. That's a discussion that we have a lot closer to the road of you being able to qualify for a mortgage and when you find your home. And that's a discussion that we have and talk about all the different products that we can work with. So.
Yeah, guys. So feel free to book a meeting on the link and put it on there. If you want to kind of go into a bit more detail, where you'll be able to discuss a bit more your personal situation, and you can get a bit more of a personal game plan for yourself. Yeah.
Very true. Alex asks, am I obligated to have a mortgage protection insurance policy? No, you're not. That is optional. Just like getting a home inspection done is optional. It's all optional. So the mortgage protection insurance policy that I was mentioning there with Manulife, that is completely optional. Yeah, that's just like life insurance, again, optional. So that's a good question.
You're welcome, Alex. Yeah, guys. So any more questions there? Do. So the meeting I'm trying to get you guys to book, just so you know, it's a no obligation meeting. You're not under obligation to work with us. Also, you're not on no money is being exchanged, no none of that. As a real estate agent, I get paid from the seller or the new home builder. Adriel gets paid from the banks, the brokers. And my colleague Gary over here, he's also a realtor, so he's like me. We get paid from the sellers. So
Yeah.
all of this is it's no obligation. It's just to chat, to get a healthy idea of where you're at and what you should be doing in order to get to where you would like to be. Because you've spent an hour with us today, so you're obviously interested in the information. You want to know a bit more. The book the call and get that health check and know where you're at. Yeah.
Yeah, no, it's a really important. Yeah, there's no money at all in terms for me or Peter or Gary until the deal closes. So this is all free, and you don't even have to pay for that. It's the seller that does. So it's a
Yeah.
service that's paid for the seller, not you.
Mhm.
Yeah, so feel free to book those calls. Feel free to ask any more questions that you have that you're curious about, unsure about.
Or anything you've heard, but you're unsure, you just want to confirm. Yeah.
Confirm if it's true or not. Yeah.
Yeah, always happy to help.